Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got a market recap with Chris Zhang. He is one of my partners and the CIO of our family office side of our business. His background, he's a highly educated derivatives and he traded kind of everything at Morgan Stanley before joining up with us. So we're going to do a deep dive today into the market dynamics that are happening. Interestingly, the story is more driven still by the Fed than by any of the turmoil in the Middle East or in the Russia-Ukraine zone. So a lot of interesting narrative around that. And we've talked about how things might move in markets in the coming months based on what we're seeing now. So hopefully this is helpful to everyone. Without further ado, enjoy. Chris, what's up, buddy?
Hey, Mark. Good to see you. Feels like it's been a century.
Yeah, it's been 15 minutes since we walked across the office by each other.
That's how much I miss you.
The market update today, I was thinking we should frame a little bit in all of the awful stuff happening around the world.
Yep.
Probably hard not to. I feel like the headlines right now are that in my feed is war and Trump. Like it's war and politics. Those are the two stories that are pervasive.
Yeah. I don't want to keep talking about bad news here too. I feel like the general impression of these calls is people think I'm the harbinger of bad news. And
I think you're just negative as in general. Just a disposition, no?
That's not true. My wife thinks I'm an optimist compared to her. So maybe we're both negative. It's just all relative.
There you go. Could be all relative.
But I do. I mean, the data is. I'm a data driven person. The data basically always tells me something negative. Unfortunately, it's hard to see things that are with a positive light when you just don't see the data. So there's some stuff I will share today. Obviously, I want to share with everyone on the macro side in the US. But yeah, like to your point, that headlines are always focused on the negative stuff, so you can't get away from it. But what on my level, what I care most about is yes, with all these war, election, and all these things sort of in our news feed. What is the ultimate impact that translates into data? Right. That's what I really want to look at. And that's I think where we should start, without just the macro picture too.
Great.
So should we talk about? I mean, if you want to just dive in, I have a few things I want to talk about regarding the job market and of course,
earnings, totally,
etc. So first thing first, I think since we have these chats now once a month, it gives me more time to reflect on what was the most important thing that happened in the past month on a macro level in the US and abroad. As far as data is concerned, it's the jobs market. For the first time in 2 years, we're finally seeing some softness in the job market. People have been waiting for this because without job market cooling down, the expectation is the Fed is going to keep hiking, which is bad for all asset classes. So October NFP, non-farm payroll, which is the leading job data that came out last week, indicated that the economy added about 150,000 jobs against an expectation of 170, which is a sharp decline against what the September number was, almost at 200,000. And the unemployment rate rose finally to 3.9%, which is the highest since January 2022. And if you look at onto the underlying data, a lot of the gains in sort of non-farm payroll came from healthcare, government, construction, so which are more viewed as seasonal, so that they're not, stable. So you're even though we gain and we added more jobs, but there's a sign of a weakness in the secondary data, and our unemployment rate rose. Importantly, as part of the job data, you also get the average hourly earnings, right? With this, we talk about this a lot internally. We view this as more of an indication of consumer spending power. It's been rising steadily, outpacing inflation for the past few months. And just logically, if on a household level you're getting, your sort of your salaries are increasing at a faster pace than inflation, your net spending power increases, which triggers down to more spending, right? So, but this past month, average hourly earning increased by basically 0.2%, which is about year on year 4.1%. And we're going to get the CPI data I think on the 14th, so it's in about a week. And we're going to compare that. The whole market is going to compare that to the average hourly earning data, because the theory is that if inflation is now all of a sudden higher pace than your job data and your average hourly earnings, people will feel poorer, and therefore less spending will happen. And that's another signal that Fed will be looking for as they consider raising interest rates, or sort of being on hold. Speaking of the Fed, they just had their meeting, most recent meeting earlier this month in November, and for the second consecutive meeting, they've decided to hold interest rates steady. And for the first time since this hiking cycle, the Chairman Powell came out with more what I would consider dovish tone, right? So he questioned in a few places in his statements, whether we should raise interest rates, and that's the first time ever he said that. Before this has always been inflation is not under control, job is still strong, spending still strong, we need to keep raising. This time is, should we continue to raise, right? The question has been asked. The market loved it. If you just stare at any indices, any charts in the equity market in the past 2 weeks, you saw this turning point. We're on our way down, and all of a sudden this 180 reversal, and people really think that the regime has shifted. Now that we're in the risk is more cutting rates as opposed to raising rates. I think, if you ask me, I think market will probably too positively and too optimistically to that. Data has not shown that we're near the inflation target, and spending is still very strong. Job market, yes, weaker compared to the last few months, still strong. So we're not there yet. So I do expect the equity market to bounce back from the rally that we've seen recently.
This is, can I just, Chris, just clarify?
Please.
This is am I correct that there's a lag between the time they raise interest rates and the kind of economic factors adapt? So hearing the dynamic that the Fed is saying, hey, things are starting to trend the direction they want.
Yep.
Pausing on raising interest rates further for the time being to see the unraveling of the work they've already done.
Yep.
Right. Seems rational. Right. Isn't that kind of, you don't keep turning a boat after it seems like it's on course.
Yeah.
You let it ride a little bit and see if it stays there.
Yeah, I think the Fed is rational. They are, they're supposed to be forward-looking, right? But the data are mostly backward-looking, and they have to be reliant on the data. And so before this turn, the market were sort of a little bit nervous about them overshooting it, right? So sort of hiking it too much to a point where it puts us in a sort of hard landing scenario, and then have to sort of cut aggressively to get us out of the hole. But now I think it's the other way around, where the Fed is acting somewhat rationally, right? Their impact in the market is finally trickling down. They're seeing the trends going in their favor. The market is now being overly optimistic, and it's as if we're not, the real estate bubble, the real estate collapse is not happening. As if we're hard landing is not even a possibility anymore. And all these, and as if war is not happening, as if elections not happening. All these risk factors are being ignored in the market currently, simply because of a shift in tone by Chairman Powell, right? So it's a very emotional reaction to
But is that
potentially.
justified? I mean, is the interest rate more impactful on outcomes economically than
Yeah,
wars and elections?
yeah, it's a
I mean,
very
it's so
complex.
powerful, right?
For sure, interest rate probably the fundamental force behind equity markets, but it's a shift in tone, right? Like we're not seeing. It's not like we're seeing they're
Right.
all of a sudden decided to cut 100 basis point rates and commit to cutting it back to 2%. We're still at 5.25%, and the 10-year, as you will see in treasuries, is still at the high of recent decades, and which trickle down to mortgage, which trickle down all these secondary rates that impact day-to-day spending consumers. We're not seeing any of that shift yet. None of it. It's just a shift in tone by the Fed. And yes, somehow the equity market already rallied back to recent highs. So that's why I personally view it as more of an overreaction. Let's see the data first. Let's see what actually happens. And then let's react to it. Right now, it's just more of an unwinding position that's sort of more technical than fundamental driven. Um,
But Chris, on the conflict, you mentioned it. We've got
yeah,
two conflicts going on globally now.
yeah,
Seem to just be adding them every 6 to 12 months at this point.
yeah.
Um, that's not factored, or it's not showing up in the market as you're describing. How
It's
significant is it from a market perspective? And are there areas that people should be concerned about or watching?
yes,
Because there's got to be some forces that come out of that, right? I'd imagine maybe
absolutely.
some oils and weapons industries for sure.
Absolutely. I think winners, losers in every scenario. But the biggest, as you mentioned, the biggest area people should be paying more attention to is energy. Because the two fronts where the wars are happening happen to be the most critical two fronts for nat gas and oil. Right? Iran, people are not talking about Iran a lot currently, but they could easily get looped into the war. And as we talked about internally, Iran produces somewhere around the 3 million barrels a day, which is not a lot from a global demand perspective. But they control the Strait of Hormuz, which is 100% control of Strait of Hormuz, which controls about 20% of the global production, the global supply chain in oil. And how does that impact um, if there is a sort of a cornering in the market happening? How does that impact oil prices, which just has too many layers of secondary, tertiary impacts in the global economy to even count? So, and nat gas from Russia, yeah, all these things that impact global supply and demand in energy market. People, I don't think are pricing it. Just looking at oil futures and these things, I don't think a market is necessarily pricing it fully in. And yeah, an impact on really just global supply chains overall. And we haven't even talked about China yet, because China, as of today, just shows probably the weakest deflationary print in their economy, and CPI and PPI both strong. And how are people, and then actually that the impact of that actually was trickled down to some U.S. companies, right? Most importantly, Apple. Apple's earning came out last week. It's the weakest in a while. They've shown 4 straight quarters of decline, mostly because of China. The demand is simply not there, right? So the biggest company in the world is getting impacted, and this is the longest sort of slide in earnings they've seen in 22 years. And these things are not being factored in to me, based on what I've seen as of yet into the equity market.
What should the equity markets are potentially inflated?
Yeah,
You know, when we any thoughts on like connecting the dots, like where this goes in the next few months that we should be paying attention to?
I would say I'm gonna. It's a really hard question to answer, but what I would say is, if I'm gonna put my trader's hat on for a second, and if you ask me, what would I put in my own personal money in terms of looking at all things, what would I put my money in for, let's say, 1 or 2 trades? And again, I'm not recommending this to anybody. I'm just sort of trying to use this as an example to illustrate my views here. The first trade I'll put on is a spread trade. I will long oil prices and short U.S. indices. So that's S&P 500 or any of the tech indices. You think? I think this is one of the fundamental forces that will drive the valuations going forward. Oil prices, of course, real estate. it's hard to short real estate. So I would basically long oil and short S&P. Okay, that's one spread trade that expresses my view. The second trade, I think this is probably there will be more people even agreeing with this, is that I want to put a steepener, what's called a steepener trade in an interest rate market. I think that the long dated interest rate in the US still has room to rise, so 10-year, 20-year. But the risk on the front end is now shifted to sort of downward. So I think the front end is likely going, risk reward wise, likely has more room to decrease rather than increase because softening in economy and the Fed guidance in interest rates. So I would basically short the 10-year, 20-year and long the 2-year, right? And then obviously price and yield are inverse. So basically what I'm betting on is going forward next couple of years, a decrease in front end interest rate and an increase relative to the 2-year in 10-year and 20-year interest rates. So if you believe these two, so this is where I will put my money, and for these two spread trades, and if those two materializes, you will see this will impact everything. This will impact the dollar, the strength of the dollar. This will impact real estate domestically, internationally, because construction loans are tied to the front end, whereas mortgage rates are tied to the long end. That dynamic will play out, unfortunately, not in favor of the real estate market, residential or commercial. And equity markets being a little bit rosy right now, and oil is likely going to rise, right? So people can think about the secondary, tertiary impacts from that.
It's really helpful.
Yeah.
Chris, always here bringing us good news. Thank you so much, buddy.
Yep. Always a pleasure. Thank you, Mark.
And a quick reminder for everybody, Chris is a registered SEC advisor. Nothing he has said should be misconstrued as investment advice. All right, everybody. Thanks for listening. Chris, as always, is bringing us great news. I think that's becoming a running joke. Maybe when the market picks back up, he'll be on the other side of the story and it'll get boring because he'll be saying good stuff every month. I want to give a quick heads up for everybody. If you haven't checked out interplay.vc, that's our website for our firm. Great place to land to kind of see what we're up to and what we're doing. We've got a venture capital business, an incubator, a foundry, a number of service companies, and the family office side of the house. You can find out a lot about the different types of things we're doing, get involved. If you're interested in working with us on something, you can just click buttons and get right to the front door, which is we require everyone to go through, and that's interplay.vc/engage. And that should get you into the system and in direct communication with the team and to the right people. So with all of that said, check us out on the website, socials. But remember, we're here for more than just a podcast. And there's ways we can help. Let us know. Thanks for listening.